What if the most important monetary move in crypto right now is not on Bitcoin but on a fast, application-focused chain that most traders still ignore? What if a network that many people once called only another Ethereum-style competitor has just cut its inflation in half at the same time that long-term capital is coming back? What if a wave of artificial intelligence builders wants to secure a very large part of that same supply before the rest of the market understands what is happening? This is the story of Near in 2025. It is a story about tighter token economics. It is a story about artificial intelligence agents living on chain. It is a story about why supply discipline matters again. Bitcoin exchange-traded funds are active. Ethereum exchange-traded funds are live. Liquidity is returning, but it is cautious, and it is choosing assets with predictable issuance, usable staking, and real adoption. In this environment, chains that issue 5% or more every year look less attractive. Chains that can fund security while protecting holders from dilution look more attractive. That is exactly where Near has moved. The foundation confirmed that annual inflation on the network will be reduced from about 5% to about 2.5% through an on-chain change. That is a real cut. That is fewer new tokens entering the market every year. That is slower dilution for long-term holders and for validators who are actually staking. This one detail changes the whole framing. Because Near did not make this decision in isolation. It made it while at the same time pushing to become the chain where autonomous, artificial intelligence-powered agents can actually run, transact, and communicate. Earlier this year, the Near side announced a fund of about $20 million to support artificial intelligence agent projects, agent-related tokens, and services that run natively on Near. That part is public and verifiable. The message is simple. If artificial intelligence agents are going to call smart contracts, settle tasks, mint non-fungible tokens for gaming, and talk to other users, then they need low fees, fast finality, and a token base that is not inflating forever. Near can now offer exactly that combination. Unverified. Inside the ecosystem, there are groups modeling deeper accumulation of Near so that agent networks and artificial intelligence builders can secure long-term access to block space and to incentives. There is no official or regulated confirmation of a fixed 10% target, so this scenario must be treated as directional and not as proven. But here's where it gets interesting. Most of the Ethereum 2025 scaling story is still about rollups that promised scale but delivered complexity. Multiple networks, multiple bridges, higher cognitive load for ordinary users. Near is offering a different experience. A single, account-based, low-friction environment that now has lower inflation and is positioning itself for artificial intelligence workloads. For Ethereum investors watching the Layer 2 race, this matters, because it shows that not every scaling path has to be fragmented. For teams working on Web3 gaming adoption, it matters, because agents and players can live on one chain without being diluted at 5% every year. For creators who watch how the immutable X non-fungible token marketplace model spread across chains, it matters, because digital assets need low-cost engines to move. Now, here is the part most people miss. When a chain lowers its issuance, demand has to do more work. If artificial intelligence builders, game studios, and institutional-style products begin to buy and stake Near, then every token becomes more important because there are fewer new ones arriving. That is why the smart money signals are important in this case. In early 2025, a digital asset arm linked to major traditional finance in Asia launched exposure to Near so that regulated investors could participate in the ecosystem without running their own validators. This is not retail hype. This is cautious capital testing a chain that has just made itself harder to dilute and more attractive to builders. Let that sink in. Smart money here is not buying a meme. Smart money is buying monetary policy plus real usage potential. This next part explains why that matters. Lower inflation is very good for holders, but it can pressure smaller validators whose rewards will now be lower. That is why the same tokenomics change included support for smaller validators and for holders who lock their tokens for governance, so that decentralization does not suffer while supply becomes more disciplined. Competition is still real. Solana is still fast. Ethereum rollups are still expanding. Other chains can also reduce inflation if they need to. So NEAR must prove that artificial intelligence agents will truly run here, that developers will continue to build here, and that users will actually feel the benefit of lower issuance. If it does that, the lower inflation profile becomes an asset for the whole ecosystem. Agents get predictable fees. Developers get a token that is not losing 5% of its value every year to issuance. Treasuries and funds get an asset that can sit beside Ethereum 2025 and not constantly bleed. If you value deep research like this, then subscribe to Crypto Wayfarer. Because we do not chase noise. We track power. Here is the strategic takeaway. NEAR just aligned its monetary policy with the next wave of on-chain demand. It tightened supply. It prepared for artificial intelligence. It already has at least one institutional-style door open. It already has the account-based user experience that rollup-heavy ecosystems still struggle to provide. For macro-aware, long-term crypto investors, that is enough to keep NEAR on the radar over the next year. Not hype, not theory, not speculation. A chain adjusting its token economics to match the adoption curve it wants. Stay sharp, stay strategic, and keep wayfaring.